You sign the papers, get handed the keys, and everyone congratulates you on becoming a homeowner. Your parents are proud, your friends are envious. Society celebrates your achievement of the American dream, but look at the documents you just signed. Really look at them, and you'll see something no one wants to acknowledge. You don't own that home. The bank does. You've entered into a 30-year contract where you'll make 360 payments, where during the first 15 years, almost every dollar you send to the bank goes to interest rather than principal, where you'll pay so much in interest over the life of the loan that you'll buy the house twice, once for the seller and once for the bank. On a $300,000 mortgage at 5% interest, you'll pay $279,767 in interest over 30 years, almost as much as the original loan amount. On a $200,000 loan at 4.33%, you'll pay $157,577 in interest. On a $330,000 loan at 7%, the interest totals $307,490, more than the original principal. And critically, for the first decade of payments, you're barely building equity because the amortization structure ensures that early payments are mostly interest. On a $100,000 loan at 6%, your first month's payment allocates $500 to interest and only $99.55 to principal. You're not buying a home, you're renting it from the bank at a rate that makes traditional landlords look generous, with the privilege of taking on all maintenance costs, property taxes, insurance, and the risk that the property value might decline while you're locked into decades of payments. This is the new slavery, not chains and whips, but mortgage documents that bind you to 30 years of labor, transferring enormous wealth from your paycheck to financial institutions while calling it homeownership, and telling you to be grateful for the opportunity to be in debt for most of your working life. Understanding what a mortgage really is means recognizing that it's one of the most effective wealth extraction mechanisms ever devised, keeping millions of people working jobs they hate, trapped in locations they might want to leave, and perpetually stressed about making payments on a debt so large it dwarfs every other financial obligation they'll ever have. The slavery isn't theoretical or metaphorical. It's financial bondage to debt that will consume decades of your life and transfer hundreds of thousands of dollars from your labor to bank shareholders who risked nothing but created the money you borrowed out of thin air and will collect interest on it for 30 years while you work to pay them back. The mathematics of mortgage amortization are designed to maximize bank profit and minimize your equity accumulation for as long as possible. When you take a 30-year fixed-rate mortgage, your monthly payment remains constant throughout the loan term. But the allocation between principal and interest changes dramatically over time in a pattern called amortization. Early in the loan, the vast majority of your payment is interest. Late in the loan, most goes to principal. This isn't an accident or a natural mathematical phenomenon. It's a deliberate structure that ensures the bank extracts maximum interest before you build meaningful equity. Here's how it works in practice on a $175,000 loan at 5% interest over 30 years. Your monthly payment is approximately $939. In the first year, you pay $11,286 total. Of that, $8,750 is interest, roughly 78% of your payments. Only $2,518 goes to reducing the principal you owe. So despite paying the bank $11,200 in year one, you've built only $2,518 in equity. The bank has extracted $8,750 from your labor as interest on money they created from nothing when they issued the loan. This pattern continues for years. In a 30-year mortgage, you typically don't pay more toward principal than interest until somewhere around the 15th year. For half the life of the loan, the majority of every payment is interest going to the bank rather than equity building for you. By the time you reach the halfway point in payments, having made 180 payments over 15 years, you've paid roughly half the total interest that will accrue over the full 30 years but have paid down far less than half the principal. The exact numbers depend on the interest rate, but the pattern is consistent: massive interest extraction in early years, minimal equity building. On that $100,000 loan at 6%, the first monthly payment of $591.55 allocates $500 to interest and $99.55 to principal. The bank extracts 5 times as much in interest as you gain in equity. By the final payment 30 years later, the split is reversed: $596 to principal and only $298 to interest. But by then, you've paid the bank roughly $115,036 in total interest on the $100,000 borrowed, while the $100,000 principal that you've been paying down over 30 years has lost substantial purchasing power to inflation. This is the first dimension of mortgage slavery. You're locked into decades of payments where the early years, when you have the least equity and the most financial stress from buying a home, are the years when the bank extracts the most interest and you build the least equity. If you sell or refinance within the first 10 years, which many people do when they move or divorce or face financial crisis, you'll find that despite making dozens of payments totaling tens of thousands of dollars, you've built very little equity because most of those payments went to interest. The second dimension is the total cost. As noted, a $300,000 mortgage at 5% interest costs $279,767 in interest over 30 years. Combined with the principal, you're paying $579,767 total to acquire a $300,000 home. You're paying roughly double for the home, with the second half going to the bank for the privilege of spreading payments over 30 years. On a $330,000 loan at 7%, you pay $327,490 in interest, bringing total payments to $657,490, nearly double the purchase price. And these calculations assume you never miss a payment, never refinance, which restarts the amortization clock, and pay off the loan on schedule rather than extending it. Think about what this means in real terms. You work for 30 years, sending $1,610 monthly on that $300,000 loan at 5%. That's $19,320 annually. For someone earning $75,000 per year gross, that's roughly 26% of gross income going to mortgage payments, which is in the range lenders consider acceptable. But over 30 years, you'll send the bank $579,767 total. If you earned $75,000 annually and paid $19,320 in mortgage payments, that's 7 3/4 years of your entire gross income going to housing payments over 30 years. Before taxes, before every other expense, you're transferring nearly 8 years of your entire working life's gross income to pay for one house, half of which is profit for the bank. The average mortgage balance in the United States in 2024 was $252,055. Assuming a 6% interest rate, typical in recent years, the total interest over 30 years would be approximately $293,000, bringing total payments to roughly $545,000 for that $252,055 home. The average American is working roughly 8 to 10 years of their career just to pay interest to banks on their mortgage, years of labor that build no equity, create no value for the borrower, and simply transfer wealth from worker to financial institution. The third dimension of mortgage slavery is the loss of mobility and opportunity. When you take a 30-year mortgage, you're geographically anchored to that property for years or face substantial costs. Selling a home involves agent commissions of 5-6% of sale price, closing costs, moving expenses, and potentially capital gains taxes. If you sell within a few years, before you've built meaningful equity, these costs can exceed your equity, meaning you lose money on the transaction despite potentially having made years of payments. This geographic immobility affects your career. If you get a better job offer in another city, you must either sell at a loss or become a long-distance landlord, adding complexity and risk. If your local job market deteriorates, you're trapped unless you can afford to sell at a loss. If your neighborhood declines or you discover you hate living there, you're stuck for years unless you can absorb transaction costs. This is the opposite of freedom. It's bondage to a location enforced by the financial costs of escape. The mobility constraint affects millions. The United States has a housing shortage of approximately 4.7 million homes, reducing workforce mobility and hindering businesses' ability to attract talent. Workers who'd move for better opportunities can't because housing markets where jobs are available are too expensive, or because they're trapped in existing mortgages and can't afford to sell and buy elsewhere. This immobility reduces economic efficiency, keeps workers in suboptimal jobs, and generally constrains people's ability to improve their situations. The fourth dimension is the risk transfer from bank to borrower. When you take a mortgage, you're assuming all the risk that property values might decline, that you might lose your job and be unable to make payments, that the property might have undiscovered problems requiring expensive repairs, that interest rates might drop making your rate seem terrible in retrospect, or that your life circumstances might change forcing you to sell at a bad time. The bank's risk is limited. They hold a secured interest in the property. If you default, they foreclose and recover their capital, often at the borrower's expense. If property values rise, you capture the gain, but the bank's return is fixed at the interest rate. If values fall, you bear the entire loss while still owing the original amount. This asymmetric risk becomes evident during housing crashes. The 2008 financial crisis saw millions of foreclosures where homeowners lost their properties, their down payments, and years of payment history while banks were bailed out by government. Homeowners who'd been making payments for years and had paid tens of thousands in interest suddenly found themselves owing more than the property was worth, underwater on mortgages. Many chose strategic default, walking away from properties because paying mortgages on homes worth less than the debt didn't make financial sense. But this destroyed their credit, often triggered tax liability on forgiven debt, and left them worse off financially than if they'd rented and invested the down payment and monthly payment differences. The foreclosure process reveals the power imbalance. Miss a few payments and the bank begins foreclosure procedures. They can ultimately seize the property, evict you, sell it at auction, and pursue you for any deficiency between the sale price and what you owe. You lose the home, your down payment, all equity you'd built, and your credit score is destroyed for years. The bank recovers most or all of their capital, writes off losses if any, and moves on to the next borrower. The mortgage documents give them extraordinary power over your life, including the legal right to take your home if payments are missed. The fifth dimension is how mortgages intersect with inflation and monetary policy to transfer wealth from borrowers who actually need housing to financial institutions and wealthy investors. In the current environment where the Federal Reserve has held interest rates at elevated levels, mortgage rates have reached 7% or higher for periods in 2024 to 2025. At 7%, that $330,000 mortgage costs $327,490 in interest. But banks don't hold these mortgages on their balance sheets typically. They originate them, collect fees, and sell them to government-sponsored enterprises like Fannie Mae and Freddie Mac, or package them into mortgage-backed securities sold to investors. This securitization means that mortgage interest doesn't primarily benefit the local bank that originated your loan. It's distributed to investors globally who purchase mortgage-backed securities. Your monthly payment is split among thousands of investors, many of them wealthy individuals, pension funds, foreign central banks, and financial institutions. You're working to make interest payments that enrich a global investor class while you build equity slowly over decades. When interest rates rise, as they have recently, mortgage payments consume larger shares of borrowers' incomes. The average mortgage payment has increased dramatically from 2020, when rates were near 3%, to 2024 to 2025, when rates approached 7%. On a $300,000 loan, the difference between 3% and 7% is roughly $650 monthly, $7,800 annually, $234,000 over 30 years. Borrowers taking mortgages at high rates are committing to decades of higher payments that transfer substantially more wealth to lenders than those who borrowed when rates were low. But those who borrowed at low rates face their own trap. Refinancing to take cash out or move requires accepting current higher rates, effectively trapping them in their current homes. If you have a 3% mortgage and current rates are 7%, selling means giving up favorable financing you can't replicate. This creates another form of immobility, keeping people in homes they might want to leave because the financial penalty of moving is too high. The sixth dimension is how mortgages interact with the tax code to create the illusion of benefits that actually primarily advantage the wealthy. The mortgage interest deduction allows you to deduct mortgage interest paid from your taxable income. This sounds beneficial, but it primarily helps high earners in high tax brackets. Someone in the 37% federal tax bracket deducting $20,000 in mortgage interest saves $7,400 in taxes. Someone in the 22% bracket deducting the same amount saves $4,400. And someone who doesn't itemize deductions because they take the standard deduction, which is now most taxpayers after 2017 tax reform, receives zero benefit from the mortgage interest deduction. The structure means that expensive homes purchased by wealthy borrowers generate large deductions that substantially reduce their tax bills, while moderate-income homeowners with smaller mortgages often receive little or no tax benefit. It's a regressive provision disguised as assistance for homeownership that actually subsidizes expensive homes for the wealthy while providing minimal benefit to those who need it most. And even those who receive the deduction are getting back a fraction of the interest they paid, maybe 25-30% if they're in a moderate bracket. They're still paying 70-75% of the interest as a real cost after accounting for the deduction. The seventh dimension is the opportunity cost of capital locked in home equity. When you make a down payment of $60,000 on a $300,000 home, that $60,000 is no longer available for investment. If instead of buying, you'd rented for $2,500 monthly and invested the $60,000 down payment in stock index funds returning cent annually, After 30 years, you'd have approximately $603,000 from that initial investment alone, not counting any additional contributions. Meanwhile, your home equity after 30 years is whatever the house is worth minus selling costs. If the home appreciated at 3% annually, typical for housing over long periods, it would be worth roughly $728,000 in 30 years. Subtract 6% selling costs of $43,680 and you net $684,320. But you paid $579,767 total for the house. $300,000 principal plus $279,767 interest. Your profit is $104,553 over 30 years or $3,485 annually. That's a 0.6% annual return on the total amount paid. If you'd rented for $1,300 monthly, that's $540,000 in rent over 30 years. Compare that to $579,767 in mortgage payments, a difference of $39,667 more in the mortgage scenario, not counting maintenance, property taxes, and insurance that homeowners pay but renters don't. Run the numbers with realistic assumptions about maintenance, 1% of home value annually, property taxes, 1 to 2% of value annually, and insurance, and home ownership often doesn't generate better financial returns than renting and investing the difference, particularly if you move before the mortgage is paid off and incur transaction costs. The financial case for home ownership is much weaker than conventional wisdom suggests, especially when you account for the mobility constraints and risks discussed earlier. The reason home ownership is pushed so aggressively by society, government, and financial institutions isn't because it's financially optimal for buyers. It's because it's extraordinarily profitable for the financial industry. Mortgage origination fees, interest over decades, servicing fees, securitization profits, and various other charges associated with the mortgage industry generate hundreds of billions annually for financial institutions. The $13.07 trillion in outstanding mortgage debt in the United States as of Q3 2025, with average interest rates of 4.6%, generates roughly $780 billion in annual interest payments flowing from borrowers to lenders and investors. That's wealth transfer from homeowners who are mostly middle class to financial institutions and investors who are disproportionately wealthy. Government encourages homeownership through the mortgage interest deduction, through Fannie Mae and Freddie Mac guaranteeing mortgages that private markets might not make, and through various programs designed to increase homeownership rates. This government support is justified as promoting economic stability and middle-class wealth building. But the actual effect is to inflate home prices through increased demand supported by cheap available credit, which benefits existing homeowners and the financial industry at the expense of would-be first-time buyers who face ever higher prices requiring ever larger mortgages. The average millennial holds a mortgage balance of $312,000, substantially higher than older generations. Not because millennials earn more, but because housing prices have been inflated by decades of loose credit and insufficient construction. The housing affordability crisis, where housing costs have risen faster than wages in nearly every metropolitan area, making home ownership increasingly difficult for younger generations, is directly caused by the system of cheap credit and insufficient supply. Loose mortgage credit allows buyers to bid prices higher because they're borrowing rather than paying cash. But this doesn't make housing more affordable. It just transfers more wealth to sellers and creates larger debts for buyers who must work longer to pay off mortgages that are larger in both nominal terms and as multiples of income. The eighth dimension of mortgage slavery is psychological and social. The 30-year mortgage normalizes a lifetime of debt as not just acceptable but desirable. People are taught that debt is how you invest in your future and that home ownership through mortgage borrowing is a sign of adult success. This normalization of debt changes psychology from saving to spend toward borrowing to buy, from delayed gratification toward immediate consumption financed by future labor, from independence toward decades-long dependence on steady employment to make debt payments. This psychological shift serves the interests of the financial system perfectly. Someone with no debt can walk away from a bad job, take sabbaticals, start businesses, move freely, or retire early if they live modestly. Someone with a $300,000 mortgage must maintain steady income for 30 years, cannot risk unemployment, must accept employer demands because the mortgage payment is due regardless and is trapped in the labor market for decades. The mortgage ensures a compliant workforce that can't afford to take risks, challenge employers, or leave the system. The social pressure around home ownership reinforces this. Not owning a home is seen as failure, as immaturity, as settling. Renters are looked down upon despite renting often being more financially rational given mobility benefits and the opportunity to invest capital elsewhere. The social pressure pushes people into mortgages they can't comfortably afford, into homes they don't really need, and into decades of debt servitude disguised as wealth building. The ninth dimension is how the mortgage system contributes to wealth inequality and intergenerational wealth transfer. Those born to wealth can receive down payments from parents or inheritances, allowing them to access favorable mortgage terms and build equity through homeownership. Those born to parents without wealth must save for down payments themselves, competing with investors and those who received family assistance, often spending years or decades unable to accumulate sufficient down payment as prices rise faster than their savings. Those who do manage to buy later in life have fewer years to build equity before retirement, often carry mortgages into retirement, and have less wealth to pass to their own children. This creates a cycle where family wealth enables homeownership, which builds more wealth through equity that can be passed to the next generation, while those without family wealth struggle to enter homeownership at all or enter later with larger mortgages that consume more of their income and build less equity. The recent increase in mortgage balances averaging $252,505 in 2024, a 3.3% increase from 2023, continues despite many families facing affordability challenges. Millennials carry average mortgage balances of $312,014, and Gen Z already averages $249,744, despite most being very early in their home buying years. These enormous debts will consume decades of their working lives, transferring hundreds of thousands in interest payments to lenders while constraining their economic mobility and financial flexibility throughout their prime earning years. The 10th dimension is the predatory aspects of mortgage lending that target the financially unsophisticated. Adjustable rate mortgages with low teaser rates that reset to much higher rates after a few years. Interest-only loans that build no equity, balloon payments that come due after several years. Excessive fees buried in closing costs. These and other predatory practices target borrowers who don't understand the full costs and risks, often resulting in defaults, foreclosures, and financial ruin. The 2008 financial crisis was triggered largely by predatory subprime mortgage lending, where borrowers were approved for mortgages they couldn't afford based on optimistic assumptions about income, home appreciation, or their ability to refinance before rate resets. When housing prices stopped rising and refinancing became impossible, millions defaulted. The borrowers lost their homes and their credit. The banks were bailed out by government. The system demonstrated that mortgage lending operates to extract wealth from borrowers through interest and fees while socializing losses through bailouts when the system's excesses create crisis. The comparison to historical slavery isn't perfect or complete, but the structural parallels are striking. Historical slavery involved people bound to labor for others with limited freedom and ability to accumulate wealth. Mortgage slavery involves people bound to decades of labor payments to financial institutions with limited mobility and financial flexibility, transferring enormous wealth through interest while building equity slowly, if at all. The historical slave worked under threat of physical punishment. The modern mortgage slave works under threat of foreclosure, credit destruction, and homelessness. The historical slave was owned explicitly. The modern mortgage slave owns a home only in name while the bank holds the title and can seize the property if payments stop. The difference is that mortgage slavery is voluntary, chosen by signing documents after theoretically understanding the terms. But the choice is heavily constrained by social pressure, the lack of affordable rental options in many markets, government policies that favor homeownership and disadvantage renting, and financial education that systematically misrepresents mortgages as wealth building rather than acknowledging them as decades-long debt obligations that transfer substantial wealth to lenders. The choice to take a mortgage is often more coerced than voluntary, pushed by circumstances and social expectations more than genuine free choice among equally acceptable alternatives. Breaking free from mortgage slavery requires either paying off the mortgage early, which requires enormous discipline and additional payments over years, or choosing not to enter the system at all by renting and investing capital elsewhere. Early payoff is difficult because lenders structure loans to make it challenging. Many mortgages have prepayment penalties. Even without penalties, making extra principal payments requires discipline and spare income that many borrowers lack. The mortgage payment is structured to be the maximum you can afford, not an amount that leaves surplus for extra payments. Choosing to rent rather than buy is financially rational in many circumstances but socially stigmatized. But renting provides mobility that mortgages don't, flexibility to move for opportunities, freedom from maintenance obligations and property tax increases, and often allows investing capital that would otherwise be locked in home equity. A disciplined renter who invests the down payment they didn't make and the difference between renting and mortgage costs can often build more wealth than a homeowner, particularly if they move frequently for career advancement or if they live in high-cost markets where housing prices have been inflated by speculative demand. The alternative that the wealthy use is leveraging real estate strategically rather than occupying it as a primary residence. Buy rental properties where the rent covers the mortgage payment, letting tenants pay down your debt while you build equity. Use leverage to control multiple properties rather than owning one outright. Treat real estate as an investment to be managed for returns rather than as a consumption decision wrapped in emotion. But this approach requires capital for down payments on investment properties and sophistication to manage tenants and properties, making it accessible primarily to those who already have wealth. The fundamental problem is that housing is both a human necessity and a financial asset, creating impossible contradictions. As a necessity, housing should be affordable and accessible. As a financial asset, current owners and investors want prices to rise. Government policy tries to serve both goals simultaneously through loose mortgage credit that increases demand and inflates prices while making individual purchases affordable through long-term debt. The result satisfies neither goal effectively. Housing becomes less affordable as prices rise and buyers take on enormous debts that enslave them to decades of payments. Understanding lifetime mortgages as a form of modern slavery means recognizing that the 30-year fixed-rate mortgage, presented as the foundation of middle-class wealth building and the American dream, is actually a mechanism that transfers enormous wealth from borrowers to lenders, constrains borrowers' mobility and life choices for decades, exposes them to substantial financial risks, and normalizes lifetime debt as responsible behavior. The slavery isn't metaphorical. It's the binding of labor to debt for 30 years, the surrender of freedom and flexibility, the acceptance of decades of payments where early years mostly pay interest, the risk of losing everything if payments are missed, and the ultimate realization that you've paid double the home's purchase price to own something you could have rented while building wealth through other investments. If this gave you a new perspective, hit subscribe. The mortgage you think makes you a homeowner actually makes you a debtor for 30 years. The payments you think are building equity mostly pay interest for the first half of the loan. The interest you pay over the life of the loan often equals or exceeds the original principal. The mobility you sacrifice and the financial flexibility you surrender make you captive to geography and circumstance. The risk you assume while the bank's risk is secured and protected makes the relationship asymmetric. And the wealth transfer from your labor to financial institutions over 30 years, paying double for a house while calling it ownership, makes it clear that the mortgage isn't a path to wealth. It's a trap that binds you to decades of labor, extracts hundreds of thousands from your lifetime earnings, and calls it the American dream while keeping you working, stressed, immobile, and perpetually in debt to the banks that created the money you borrowed from nothing and will collect interest on it for 30 years while you work to pay them back. The new slavery doesn't need chains. It just needs mortgage documents you sign willingly, believing you're buying a home when you're really selling 30 years of your labor to financial institutions who will profit enormously while you work a lifetime to pay interest on debt that never should have been necessary in a just system that provided housing without enslaving people to multi-decade financial obligations that transfer more wealth to lenders than any feudal lord ever extracted from serfs. You're not a homeowner, you're a mortgage slave. And until you pay off that 30-year debt or choose never to enter the system, you'll remain in bondage to banks that own your home while you pay them for the privilege of slowly, painfully buying back your freedom one monthly payment at a time.